Jan has a wealth of great ETFs. You have one of the largest oil ETFs, so oil services. OIH is the symbol here. And those who don't know, this owns all the big guys. It owns Schlumberger and Halliburton and Baker Hughes. But energy stocks have badly lagged the S&P as oil prices have been trending down since September, to everyone's shock, post the Israeli-Hamas war. So tell us a little bit about what's going on there. I've sort of answered the question about what's going on, but
it's an unloved sector.
Yeah,
like Tom is saying, like
earnings estimates are coming down for energy right now.
Yeah. So I mean, look, the bullish case for energy to me is that you're at all-time highs in global oil demand. So it's 100 million barrels a day. That's still growing at 1 to 2% a year.
Wait,
not in the U.S.
The bullish case is what?
Oil consumption globally is at 100 million barrels a day, and it's still growing. It's not growing at NVIDIA rates. It's growing at 1 to 2%. But that's global. That's in a world where China is in a recession, let's call it. So other growth drivers in the world, and I look at Brazil and India, kind of those are my favorite countries to talk about, have not yet picked up the demand. So it's a weak demand, but it's a growing demand supply situation globally. And energy companies can do all right. There is growth in that sector because the world, remember, with depletion, you do need new discoveries, new services, new production globally. That's the best I can say.
And the supply is there. I mean, the bear case is supply keeps matching any. U.S. we're pumping 13 million barrels of oil a day.
The supply's there. The companies are arguably the next best cash flowing companies and the semiconductors. They're trading at double-digit cash flow yields for E&Ps and sectors in the oil market. No one cares. No one cares. We should just take them private, Todd.
Well, that's why they still have great dividends, right? Because of strong cash flows.
I agree with you on that, on the idea of them being, the sector being unloved. You had pretty large outflows last year. And if tech were to take a hit at some point in this quarter, I would guess the more tactical folks rotate into stuff like energy or even healthcare, right? Those are the more unloved corners in our work, just in terms of look at the flow data.
Yeah. But I agree, it's unloved, despite the great yields.
Yeah.
And no sign that anybody's cutting any dividends at all, not a peep out of anybody, and that's what people care for. I mean, you look at some of these yields where, OIH, this company's 4%, 5%.
There's an integrated that made $3 billion in just trading energy last quarter. They're situated just to mint cash, and shareholders don't care.
You also run a small fund that owns uranium and nuclear stocks. This is NLR. People want to write it down. Nancy, Larry, Robert. Just hit a new high the other day here. It's a curious fund. It owns nuclear stocks, but also owns utilities. It owns Constellation, PG&E, public services. I guess these are utilities that own nuclear facilities, right?
Exactly. It's leveraged to the use. It's really a full spectrum play on if you think that use of nuclear is in a secular growth market.
Isn't the problem though, if just owning PG&E, it's a tough way to get leverage in nuclear on that. Isn't that the problem?
Yeah, the most leverage is a pure miners play, and one of our competitors has that. We think those companies are very volatile, and I'm not sure they make a fully diversified portfolio. So we include a healthy chunk of them to get the upside in a bull market, but there's also profits to be made now. Nuclear has been challenged occasionally on the operating side and regulatory setbacks, right? So there has to really be, I think for me, I don't know if you agree, Todd, but a real policy reversal. And you still have Germany shutting down all its nuclear plants, Japan being very hesitant. But I think investors are starting to say that's changing.
Yeah. The problem here, again, this is the example of owning stuff where you can move. The utilities get hit when rates go up, independent of whether they're heavily in nuclear. So it's hard to get that as a pure play. It's a problem we have a lot of these sectors where other things kind of influence them.
But it's not a utilities fund. These utilities are really leveraged to nuclear.
Any thoughts on?
Well, Jan mentioned the policy risk, right? The way that some of these funds are trading would suggest maybe the door is opening for that. But they're also such high flyers right now that any sort of mistake on that side will send them tumbling, I would say. So that's the risk going forward. And I think you're also starting to see volumes really climb for some of the uranium-type products. So that suggests to me that maybe we're getting a little overcooked, overdone in terms of the sentiment there. But it's the best place in energy right now, as the rest of the sector is still trying to figure out where it's going next.
Yeah, well, it makes some sense, though. I mean, hydrocarbons are, you know, in theory, not going anywhere, but there's plenty of supply. Demand is a little lower, partly due to China. That's a tough one to play right now. I mean, and the whole, you know, solar space is a tough one to play still. Wind and offshore has been tough recently. Nuclear, nothing irrational is happening here in terms of the prices. It makes sense that what little pieces there are in nuclear are outperforming energy, which is magnitudes of order bigger.
Yeah, I mean,
I think the support we need is just better global growth. And I think China's recession is really weighing on that. And frankly, I think we're doing better for the whole commodities spectrum. I know it's underperforming a lot of other things, but not really badly, considering the driver for global growth is really on its back right now and could be for a couple of years.
Yeah.